Suddenly we had a global economy and the labor supply was 24 times larger. And the US economy could suddenly hire workers on the other side of the world and pay them 90% less than American workers. So this was extremely disinflationary, and it radically changed the way the global economy works. Of course, the trade surplus countries, led by China, they had an extraordinary economic boom. And that's what I've witnessed all during my career.
Welcome to Street Smart Success, the show for high net worth investors. Whether you're investing in real estate, private equity, private credit, debt, or other alternative assets, this is the show for you. This is Roger Becker, your host. Learn with me as I drill down with guests on their paths to success, what they learned, and what they're doing now. So today we have with us a very interesting, highly accomplished, thoughtful, I'm going to even say cerebral and well-known economist. The timing of this conversation is beyond impeccable, given that it is the day after the 2024 presidential election and other elections as well. He is returning because we couldn't get the great conversation into one episode a month ago. He's coming back. He once again is the author of The Money Revolution, How to Finance the Next American Century. And he's also the publisher of Macro Watch, which is a great video newsletter that analyzes the forces that drive our economy and financial markets. He is back to Street Smart Success. Richard Duncan. Richard, welcome back to Street Smart Success.
Roger, thank you for that kind introduction.
You are absolutely welcome. You know, I got some things I want to ask you that dovetails, Richard, on our last conversation. But before I do that, only because it's timely and I can't really help myself, what is your take on the election results, the U.S. election results, for the audience sake? You're in Bangkok, and how it applies to what you do, and then we could then commence from there.
Okay, well, of course, that's a topic that we could discuss for hours and hours just on its own.
Of course.
Let me dive in then with the most important aspect of this from where I'm standing. And of course, we don't know for certain what policies President Trump will actually implement when he's in office. So we can only go by what he's pledged to do during his campaign. And one of his most repeated promises is to impose very high trade tariffs on China and 60% trade tariffs on all Chinese imports going into the U.S. and 10 to 20% trade tariffs on all of our other trading partners. So that, if that actually occurs, that is going to radically change how the global economy has been functioning for many decades, because it will sharply reduce the U.S. trade deficit, and that will change everything. Let me try to explain this. Before the Bretton Woods system broke down, the United States couldn't have big trade deficits with other countries. No country could have a big trade deficit, because if it did, it would have to pay for its trade deficit by sending its gold to the country with the trade surplus. And of course, each country only had a limited amount of gold. So if a country had a large trade deficit for very long, then it would have to ship all of its gold overseas, and it would completely run out of gold. Gold was money, and therefore it would have to stop buying things from other countries. It was that simple. Trade had to balance when we were on a gold-backed monetary system. But after the Bretton Woods system broke down, dollars were no longer backed by gold. And it didn't take the U.S. very long to realize that it could start buying things from other countries on a very large scale, and it no longer had to pay for those imports with with gold. It could just pay for them with dollars, or more actually treasury bonds denominated in dollars. So by the middle of the 1980s, the U.S. current trade deficit, the current account deficit, had blown out to 3.5% of U.S. GDP, which was entirely unprecedented. But it just kept going from there. By 2006, the current account deficit was 6% of GDP, roughly $800 billion that year. Now, why this is so important is when the U.S. became able to buy things from other countries, especially other countries with very low cost labor, like China and Vietnam and Mexico and now India, Bangladesh, that put a lot of downward pressure on U.S. wages and U.S. prices. It was very disinflationary. In the early 1980s, we'd had the two oil shocks during the 1970s. The inflation rate was roughly 15% in the early 1980s. But once we started buying things from other countries with low-cost labor, then the inflation rate started coming down very rapidly. And as the inflation rate came down, then that made it possible for interest rates to come down. And so as interest rates went lower and lower, this was great for the economy because it was cheaper for consumers to borrow and to spend, cheaper for businesses to borrow and invest. It was good for the stock market. Stock prices went up and property prices went up. So this allowed the U.S. government. So before that time, when we were on a gold-backed monetary system, the U.S. more or less had to operate within a closed domestic U.S. economy. There were only so many American workers. There were only so many American car factories. There were only so many American steel factories. But once this regime change occurred and dollars stopped being backed by gold, suddenly we had a global economy and the labor supply was 24 times larger. And the U.S. economy could suddenly hire workers on the other side of the world and pay them 90% less than American workers. So this was extremely disinflationary, and it radically changed the way the global economy works. Of course, the trade surplus countries, led by China, they had an extraordinary economic boom. And that's what I've witnessed all during my career. As I mentioned last time, I started off my career in Hong Kong in 1986 as an equities analyst. So I've watched globalization unfold, and as it has caused a very rapid industrial revolution across Asia that has created vast amounts of wealth here and pulled hundreds of millions of people, literally hundreds of millions of people out of poverty. And at the same time, by making interest rates very low in the U.S., that has helped the stock market go to record highs and fueled property prices as well. So if we actually do have 60% trade tariffs on Chinese goods and 10 to 20% trade tariffs on all of our trading partners, then this is going to change everything, because suddenly everything we import from China is going to cost 60% more. And last year we imported $300 billion worth of goods from China. So this is going to cause a spike in inflation in the United States. And as inflation moves up, then the Fed will have to increase interest rates. And as the Fed increases interest rates, then it's going to be bad for the stock market. It's going to be bad for the property market. And this is just the first round effect, because of course, if these tariffs are imposed, then it won't be profitable for American companies to have their factories in China anymore. So many companies will relocate their factories back to the United States and have to hire a lot of workers. But the U.S. economy is already at full employment. The unemployment rate's only 4.1%, which is near historic lows. So if these factories come back to the U.S. and start looking for U.S. labor, then they'll have to pay a lot more for the labor. They will have to pay more than the American workers are currently earning. And so this second round effect will also be very inflationary, as it will set off a wage push inflation spiral that will keep the inflation going for years in the future, meaning high interest rates for years ahead. And then on top of that, if President Trump does deport 11 million people, that's about 7% of the U.S. workforce. 159 million Americans are working. So if you deport 7% of them, this is going to create a severe labor shortage, and that's also going to drive up wages and prices and inflation and interest rates. So those things are alarming. And then beyond that, of course, this will be devastating for China's economy and for the economies of our trading partners. So they will all be poor, and they will have less money to buy things from the United States. And on top of that, they will retaliate with their own trade tariffs on U.S. goods, as China did in the first round of our trade war with China. Things like high tariffs on soybeans and all the agricultural products that the American farmers grow. They'll all be hit with very high trade tariffs from China. So that's likely to cause a glut of agricultural products and therefore falling agricultural prices. And so the U.S. will export less.
something tells me that Trump, who's, his primary interest, he's a business guy and tends to be transactional in nature. I have a hunch, I could be wrong because I don't really know, but I have a hunch that was just campaign rhetoric, because I don't think he would do something that would have that potentially negative impact on his own finances, quite frankly. And maybe it's just something that he knew would sound good on the campaign trail, but will ultimately knows it's not, it's illogical, and will have maybe people around him that will tell him that, or it could just be a starting point in a negotiation with China. That would be my guess and, of course, wish.
Well, of course, that may be exactly correct, but I'm not so sure. Last time he did impose trade tariffs on China. And
how high were they?
Well, it varied from product to product, but they were much less than 60%. And China retaliated with trade tariffs on U.S. exports to China. But the U.S. sells $150 billion worth of goods to China. They would potentially all be subject to very high trade tariffs going into China, making them uncompetitive. And this is the one theme that has run through his public career, his repeated insistence that the United States is being stupid by allowing these other countries to take advantage of us. And he says again and again that he wants to bring the trade deficit back closer into balance, one way or the other. And all of the advisors that he has around him, Robert Lighthizer, the former chief trade negotiator, all of these people believe this very strongly. So all of America's trading partners are terrified. China, Mexico, Vietnam, Germany, Japan, Canada, Ireland, South Korea, Taiwan, Italy. Those are the top 10. All those economies could be hit quite hard by tariffs. They're not going to come out, whatever the end negotiation is going to leave them worse off and their economies weaker.
Well, Richard, is he trying to force them to buy more of our stuff?
Yes, he's trying to force them to buy more of our stuff, and he's trying to make American factories relocate within the United States.
Right.
So that we produce more stuff domestically.
Well, I don't know but not too many people have ever accused Trump of being overly logical or rational. So sounds scary.
So this is a big problem for all the reasons I've already mentioned. And another aspect of this potentially harmful trade tariffs is this. Last year, the U.S. current account deficit was $900 billion. This year is going to be about $1 trillion. This is roughly the trade deficit. So we can think of this as the trade deficit. Now, when the U.S. has a $1 trillion trade deficit, that throws off $1 trillion into the global economy. So our trading partners, they sell their goods in the United States. They get paid in dollars. They take those dollars back to wherever they live, China or wherever. But then they have the dollars, and they have to do something with those dollars. And what they do with them is they buy U.S. dollar-denominated assets like treasury bonds. And so if the trade tariffs are successful and reduce the U.S. current account and trade deficit as President Trump hopes that they will, then that will mean that fewer dollars are going overseas every year. And that will mean that fewer foreign dollars are coming back into the United States every year. So if, for instance, the tariffs succeed in reducing the current account deficit by half, reducing it from $1 trillion to $500 million, $500 billion, then there would be $500 billion less foreign capital coming into the United States every year to do things like help finance the U.S. government's budget deficit, which last year was about $1.6 trillion, and which everyone expects to become larger now that the future Trump administration is expected to pass large tax cuts. So this, with less foreign capital coming in to buy U.S. government bonds, that means the price of government bonds would be lower than they otherwise would be. And therefore, the interest rates on those government bonds, their yields will be higher. So again, smaller trade deficit means less capital inflow into the U.S., and that means less money coming in from abroad to finance the U.S. budget deficits, which means higher interest rates.
How does a guy like Lighthizer then, he's not a dumb guy. He's got to understand the ramifications of this. What's the counter, whether or not it makes sense? What's the counter argument to this from his or Trump's perspective?
I think they're looking at this from a few different angles. But one of the most pressing is that they can see that allowing China to have such an enormous trade surplus with the U.S. is allowing China to grow very rapidly economically. And now both sides, Democrats and Republicans, all realize that China is becoming a very grave threat to U.S. national security because its economy is growing so rapidly and because their government is investing in future industries and technologies on an extraordinarily aggressive scale with a plan to dominate all of these future industries and technologies within 10 years from now. And of course, if they have technological dominance, that means they have military dominance. So this is a grave national security threat to the U.S. And I recognize that and don't disagree with that reasoning. I think China is a grave national security threat to the United States and increasingly so with each year that goes by. But to also impose tariffs on all of our other trading partners at the same time, those countries are not national security threats to us. As we increase the tariffs on China, we need to allow the companies that are producing goods in China now for the United States, we need those companies to relocate to other low-wage countries like India and Bangladesh, Vietnam, so that we can continue to buy products at low cost, but just not from China. And if we can continue to buy products from other countries with low-cost labor, then that will mean that globalization will persist, and it will persist and continue to put downward pressure on U.S. prices, inflation, and therefore interest rates. And low interest rates, as we have enjoyed almost all of this century, except during the COVID period, would be very beneficial to bringing about greater economic growth in the U.S.
That makes a ton of sense. Thank you for what an interesting dynamic. So we've got some interesting times ahead. I guess, to summarize it, Richard, it sounds like then, raising tariffs considerably against China, maybe not at 60%, if we're able to basically diversify our trade relationships and perhaps enhance them, we might gradually be able to replace the amount of trade we do with China, and therefore we can then, still have reinvestment back into our economy and also potentially reduce the existential threat that China has to the U.S.
This is a little bit tricky, though, because, of course, China is aware about what's going to soon hit them in terms of much higher tariffs. So China itself has relocated a lot of its factories out of China and into Vietnam and into Mexico. Therefore, to keep out the Chinese goods, we're somehow going to have to keep them out when they're manufactured in Mexico and Vietnam as well, or wherever in the world they're manufactured.
What a hornet's nest, how complex. Very, very, very frightening. Let me switch gears, and I want to pick up, Richard, where you and I left off, I think about a month ago, 5 weeks, something like that. And, you were very forthright, and I appreciated that about our debt. You didn't envision, you correct me if I'm wrong, if my memory is not serving me well, but the notion that we could sustain more debt from the perspective that it wouldn't necessarily produce more inflation or higher interest rates because of globalization. Is my understanding to begin with accurate, and or my memory? And if so, maybe if you could, I guess, elucidate on that, because that's about where we left off.
Yes, so U.S. government debt is about $36 trillion now. That's gross government debt. That's something like 122% of GDP, which is nearly as high as it was at the end of World War II. And one reason that the country has been able to sustain so much debt is because interest rates have been so low up until COVID hit. During COVID, of course, they went from zero. There was initially deflation during COVID. Then they peaked at 9%, the CPI. And now the CPI is back down to 2.1% because the supply chain bottlenecks have been worked out and goods prices are actually falling again. So very low inflation means very low interest rates, and low interest rates mean that the government has to pay less on U.S. government debt. So the Fed has started reducing the federal funds rate. It cut already 50 basis points And later this week, it's expected to cut another 25 basis points. And they're forecasting that they're going to continue cutting interest rates. I think by the end of 2026, their current forecast suggests that they will cut the federal funds rate from its peak a couple of months ago of 5.25%. They now expect that this will be down to 2.6% by the end of 2026. And what that means is that the cost to the government of financing its large government debt will fall again because the interest will go down. So the cost of the interest expense to the government will go down. Now, if we do have very high trade tariffs, then as I discussed earlier, that will lead to very high inflation. And that will lead to very high interest rates, even higher than we've seen so far. We'll be back potentially in the extreme inflationary days of the 1970s, where we had double-digit inflation and 20% federal funds rate in a worst-case scenario, or in a bad scenario, not necessarily the worst-case scenario. And of course, that would cause the interest expense on government debt to skyrocket and become increasingly unaffordable. But if globalization does persist, then we can have low rates of inflation and low interest expense, and that makes the government debt more sustainable. And as we were discussing a bit earlier, as long as the U.S. continues to run very large current account deficits, as it has been doing for decades, that means a lot of foreign capital inflow will come in and buy government bonds. Right now, for instance, out of the $36 trillion of total government debt, foreigners own more than $8 trillion of that. $8 trillion, that's 23% of the total. Now, why do the foreigners own $8 trillion? Because they've had such a large trade surplus with the U.S. for decades. Since 1971, the cumulative U.S. current account deficit has been $16 trillion. So that's thrown off $16 trillion into the global economy that had to be reinvested in U.S. dollar-denominated assets. So the largest owner of U.S. government debt is the foreigners, the ones with the big current account surpluses, the trade surpluses with the U.S. They own 23% of all government debt, and the Fed owns another 11%. So combined, the Fed and the rest of the world own 34% of all U.S. government debt. Now, if we were to go back to a world where we have balanced trade, then suddenly foreigners would be buying $1 trillion less government bonds every year. And that would make it much more difficult for the U.S. to finance a growing level of government debt. But I think the best way forward, and this is something that President Trump is in favor of, is to establish a U.S. sovereign wealth fund to invest aggressively in new industries and new technologies to cause U.S. economic growth to accelerate. We discussed that at great length in our last conversation last month. So I think the best way to make sure that U.S. debt is sustainable is to make the economy grow much more rapidly. And the way to do that is to have the U.S. government finance investments in new industries and new technologies on a very large scale so that it turbocharges U.S. economic growth, induces a new technological revolution, and creates technological breakthroughs and medical miracles that make everyone much better off. And at the same time, these investments would be enormously profitable and make the economy grow. So that's one of his policies that I support most strongly. I think that's the way forward, to invest aggressively in new industries and technologies, the way that China's government is doing, so that they don't surpass us technologically and then dominate us militarily, as they're likely to do otherwise. So that's the way forward, in my opinion.
Larry Fink, who's a founder, I think he's a founder of BlackRock, just wrote an article that appeared this morning saying very close to the same thing that you just said.
Yes, I read that.
Yeah.
That was great. I was so happy to see that.
Yeah. I was going to say, as you probably read, does higher inflation always produce higher interest rates?
Under normal circumstances, it does, because if the inflation rate, let's just say, for example, is 10%, no one wants to lend any money to anyone else at less than 10%, because then they would be losing money. That's pretty straightforward. But there are exceptions. For example, during World War II. During World War II, of course, the government took over complete control of the economy, and that included controlling interest rates. So when the war started, of course, all of the government spending overstimulated the U.S. economy, everybody had a job, and all of the factories were working at full capacity. So we had high rates of inflation begin to set in. But the government imposed price controls. So we couldn't have inflation because the government dictated at what price everything would be sold. And at the same time, the Fed controlled the level of interest rates. They pegged interest rates on government bonds at 0.3% on short-term bonds and at 2.5% on 10-year bonds. So interest rates couldn't go up because the Fed pegged them. And also at that time, there were bank regulations that regulated how much banks could pay on deposits, and in many cases also on the usury laws that determined the cap on how high the banks could lend, the rate of interest at which banks could lend. So in normal circumstances, yes, high inflation does determine interest rates, but in extreme cases, government intervention can control prices and interest rates. But of course, when you impose price controls, you end up having shortages. In World War II, there were shortages of consumer goods and all kinds of shortages. There weren't enough things for people to buy. So there's a price to imposing price controls.
Okay. Richard, you are a fount. I think it's a font of information, a wealth of information. So globalization keeps inflation, it helps finance our debt. It kind of keeps the wheels turning. Are there other impacts? What are other impacts of globalization?
Those are the main impacts. I mean, first of all, the countries with the surpluses grow very rapidly. I frequently visit Vietnam, and Vietnam is currently booming because its trade surplus with the U.S. is growing so rapidly over the last 10 to 15 years. They're going through the sort of radical transformation that all of the other Asian countries have experienced as a result of having a large trade surplus with the U.S. This is what I have witnessed firsthand all through my career living in Asia, is watching Asia develop primarily as a result of its very large trade surplus with the U.S. And this has meant that this part of the world has become radically more prosperous than it used to be. The first time I saw China in 1986, it was a very, very, very poor developing country. And developing was a bit of a stretch. Now, China has much better infrastructure than the U.S. does. Shanghai looks like the Emerald City in The Wizard of Oz. This transformation has been the result of the U.S. trade deficits and China's trade surplus. And the same thing has played out all across Asia. And of course, as China has grown, it's imported more goods from other countries. China's become a major importer of all commodities. If China were to go into economic crisis, it would buy far fewer commodities. And so not only from the US, but from all countries. So commodity prices would fall quite sharply. So the entire global economy has been transformed and fueled by the credit that has been the byproduct of the US trade deficits. And in other words, globalization. If globalization came unwound, those benefits would go into reverse, and potentially we would see tens, if not millions, of people falling back into dire poverty around the world.
Wow, Richard, you know what? Shame on me. I just didn't know. Here we are, round two, and I'm learning an incredible amount. It really sheds light on how powerful the United States is economically from a global perspective, and how much revolves around the great US of A. Shame on me, I didn't really know to the extent until hearing you describe it the way you're describing it. Unbelievable.
It has been absolutely incredible. If the US had not had a current account deficit, then Asia wouldn't have developed like it has done over the last 30 years. It would still be very much poorer than it is now. So yes, this trade deficit has transformed the world.
Yeah. I was going to ask you something else. And here's what it is. And I guess, of course, it's going to depend on what happens. But given different scenarios, what do you think are the safest or best asset classes to invest in over the next decade? I in a way, I feel silly asking a question because it obviously depends on so many different variables, but I'll leave it at that.
Okay. I would answer by saying the safest is probably buying a piece of land with a rental house on top of it and renting it out. And over time, If there's inflation, then the price of your land will appreciate like gold does when there's inflation. And meanwhile, you have the cash flow from your house on an ongoing basis. It involves a little work, but I think that is the safest investment over the next decade. But there's a good reason that all the investment textbooks teach that investors should have a broadly diversified portfolio. And I believe that is correct. I think investors should have stocks and bonds and some gold and spread your risk around a bit. Over time, stocks have been the highest returning asset. And the government has certainly done a great deal to make sure that they keep appreciating, but you can never tell. If we have the wrong government policies, then we could have a very significant crash in stocks. So it's not certain that they're going to continue to be the best performing asset over the next 10 to 20 years. But on the other hand, there's a good chance they will be.
What do you think about crypto?
I can't be an expert on everything. And there are just some things that I don't think about or try to become an expert on. And crypto is one of them. So you'll have to ask somebody else about crypto.
Boy, I appreciate your honesty. How long, given all the intricacies and the dynamics around globalization and trade, how long, or what will impact how long the dollar will be the world's reserve currency?
The reason the dollar is the world's reserve currency is because at the end of World War II, of course, our side won, but the U.S. ended up with most of the world's gold, and therefore they set up the Bretton Woods system in which the dollar was pegged to gold, and the currencies of other countries were either pegged to gold if they had any gold, or they were pegged to the U.S. dollar. So there were fixed exchange rates with the dollar as the main global reserve currency. But over time, the reason that the dollar is still, Bretton Woods broke down in 1971, and afterwards, the dollar was no longer pegged to gold. The reason that the dollar is still the international reserve currency is because the U.S. has such a big trade deficit every year and throws off more and more dollars into the global economy every year. As I mentioned before, the current account deficit this year is going to be about $1 trillion. That means that foreigners are going to end up with another $1 trillion this year. And there are just so many dollars in the world. That's why the dollar is the international reserve currency. So even if we were to go to a completely different trading arrangement and return to a period where trade is in balance again, that would stop throwing off new dollars into the global economy. But there's already so many dollars in the global economy that the dollar would continue to be the dominant currency for decades to come. Of course, if we have a war with China and or Russia, then they would have to set up a completely different currency trading block of their own. But then we're talking a disaster scenario with, of course, potentially catastrophic consequences all around that would extend more than beyond the dollar just losing its status as the main international reserve currency.
So I guess if we in bringing this back to the beginning and at the risk of being redundant, and again, Trump is, if nothing else, he's a negotiator. But I guess if we somehow, fall out with China, there's a lot of risk.
There are risks either way. We've already fallen out with China.
Yeah.
We have fallen out with China. It's just a matter of, are we going to literally have a war with them?
We're not ending this on a happy note. Well, very interesting. Richard, my goodness gracious. Listen, thank you so much for coming back on. Can you talk about Macro Watch a little bit and perhaps educate our listeners in terms of how they can subscribe and, how to learn more from you?
Yes, Macro Watch is my video newsletter. I sell it on a subscription basis. The goal of Macro Watch is to teach people how the economy really works in this new economic environment we're in. Most people were taught the same sort of economic textbooks at university that were circulating 100 years ago, the same theories, essentially. But the global economy, the world economy, doesn't work the way that it did when dollars were backed by gold. It works very differently now. So in Macro Watch, I explain in simple terms the way the economy really works now. The forces driving the financial markets and the global economy in the 21st century. I produce a new video every couple of weeks discussing something important happening in the global economy and how that's likely to impact asset prices, stocks, bonds, commodities, currencies. So I hope your listeners will take a look at MacroWatch. They can find it on my website, which is richardduncaneconomics.com. That's richardduncaneconomics.com. And if they would like to subscribe to MacroWatch, hit the subscribe button there, and they'll be prompted to put in a discount coupon code. If they put in the discount code, then they can subscribe at a 50% discount. The website's Richard Duncan Economics. And at the very least, they can sign up for my free blog there and follow my work there. I've been doing MacroWatch now for 11 years, so there are more than 100 hours of videos in the archives that subscribers have access to that have discussed all the main developments over the last 11 years. So I hope your listeners will take a look.
You got it. I hope they do too. And Richard, thank you again. And what a timely time to have this conversation. I very much appreciate it, and I'm going to be going to sleep sooner than you will be, I think. You said, what time is it in Bangkok? Oh, you're not in Bangkok. You're up north, right?
Oh, I am up north today. Okay. It is coming up to noon here, a little bit before noon.
I got it. It's 9 o'clock here. Richard, thank you so much. I really appreciate it.
Roger, great speaking with you again, and thanks for having me back. I look forward to the next time.
You and me both. Thanks, Richard.